Welcome to the Deep Dive. Today, we are cracking open the Q3 2025 earnings conference call for Valens Semiconductor, ticker VLN. This one hit the wire pre-market on November 12th, and it set up an immediate test. You've got this semiconductor stock that, unlike the big AI names, has been really lagging the sector this year. They needed a perfect quarter.
And on paper, they delivered it, but the market clearly wasn't buying it. Let's just start with the numbers because they tell a pretty clear story of execution. Revenue came in at $17.3 million.
Okay, and what was the street consensus on that?
The street was way lower at $15.4 million. And this is actually the sixth straight quarter of sequential revenue growth, so the top line is definitely moving in the right direction.
Wow, a 13% revenue beat is, that's a massive for a company at this stage. Did profitability follow?
It absolutely did. Non-GAAP EPS was a loss of just 4 cents per share. Consensus was looking for a 7-cent loss.
So better there too.
Much better. But the real story, I think, was on cost control. Their adjusted EBITDA loss was only $4.3 million.
And what was their own guidance?
That's the thing. Management guided for a loss somewhere between 7.4 and 6.8 million. So they didn't just beat their guidance. They completely crushed it.
So wait, let me get this straight.
Yeah.
We have a clear triple beat. Revenue, non-GAAP EPS, and their EBITDA loss was way better than guided. This sounds like the kind of report that should have sent the stock flying, especially in this market. So where did the narrative fall apart?
It fell apart almost immediately. Despite all those great numbers, the market reaction was, it was cautious, to say the least. The stock closed the day down about 5.6%.
On heavy volume, I saw.
Very heavy volume, like 4 to 5 times the daily average. And a sell-off like that on a clean beat, it just tells you one thing.
That the good news was priced in and the future outlook wasn't good enough.
Exactly. Investors were looking past the great Q3 and focusing entirely on the guidance for Q4 and beyond.
Okay, so let's unpack that, because there's a big divergence happening under the surface here. The whole story is in the mix shift between the two main segments, right? The cross-industry business, or CIB, and automotive.
That's it. The CIB segment, that's their pro-AV, industrial, and medical stuff. That was the powerhouse this quarter. It brought in $13.2 million, which is, 75% of the total revenue.
75%, wow.
And it wasn't just growing, it got more profitable. The gross margin for CIB hit 69.1%.
What was driving that strength in CIB? I know pro-AV has been a mixed bag for a while.
It seems to be a combination of a general pro-AV recovery, especially for things like command centers, and really high demand for their long-range 4K chipsets, the VS3000. They mentioned conference room cameras, matrix solutions, all the things that need perfect video over long distances. Plus, they said U.S. tariffs are becoming less of a headwind for that segment.
Okay, so that's a fantastic story for CIB. But then you look over at automotive, and it's a completely different picture.
It's a complete anchor on the P&L right now. Automotive only brought in $4.1 million, just 25% of revenue.
And that's down not just from last quarter, but from last year, too.
Right. And they were pretty direct about why. They pointed to manufacturing line transitions, a bad product mix, and said the U.S. tariffs are hitting this specific segment the hardest.
And the margin impact there has to be critical.
It's everything. You've got CIB hitting almost 70% gross margin. And then automotive, because of all those one-time operational costs, its gross margin fell all the way to 43.2%.
So you have a high-growth, high-margin engine being dragged down by shrinking low-margin one.
That's the tension in the entire report.
Okay, but before we get too focused on the burn, let's talk about the balance sheet, because despite those GAAP losses, they seem to have a pretty big safety net.
They really do. The GAAP net loss was still $7.3 million, so they're definitely not profitable yet. But they ended the quarter with $93.5 million in cash and equivalents, and this is key, 0 debt.
0 debt. So that net cash position is pretty substantial. It works out as something like 83 cents a share, right?
Exactly, which is the market's big question. That $7.3 million GAAP loss, even though it's getting smaller year over year, it makes investors nervous. How long does that $93.5 million cash pile last if automotive doesn't recover?
That's the whole runway debate.
It is. The cash buys them years to execute their plan without needing to dilute, which is a huge asset. And they were using it to support the stock. Their $23.4 million buyback program from this year is now fully used up.
So they were buying back stock as recently as Q3.
Yep. They spent $3.6 million on buybacks in the quarter, but they also said they're pausing that now to focus all their capital on R&D and scaling the business.
Okay, so strong results are in the past. The market is forward-looking. Let's dig into that forward guidance and the other strategic moves that seemed to trigger the sell-off. And we have to start with the CEO transition.
Yeah, this is a big one. You're layering execution risk right on top of the financial questions. The founding CEO, Ben-Zvi, is stepping down. Effective the day after the call, Yoram Salinger is taking over.
And Ben-Zvi is staying on the board, so it seems like a planned handoff, not a sudden departure.
It does. They're framing it as the next logical step to accelerate growth. But, changing leaders when you're in this critical scaling phase, it always adds a layer of uncertainty.
Right. And what's the mandate for the new CEO?
Yeah.
And how did the Q4 guidance reflect that?
The mandate's pretty simple. Get to profitability. But unfortunately, the Q4 guidance didn't really help that story. Revenue is guided to keep climbing, somewhere between 18.2 and 18.9 million. But the margin outlook was the real issue.
So Q3 blended gross margin was 63%, thanks to that amazing CIB mix. What are they guiding for Q4?
A big step down. They're guiding for 58 to 60%.
Oof.
Yeah. And the reason is mix normalization. They expect that high-margin CIB business to cool off a bit, which compresses the total margin. And that's what really scares investors.
And the EBITDA loss.
Guided to be roughly flat quarter over quarter, so no improvement there.
So the fear of margin compression is just overshadowing everything else, even though they're still talking about scaling to, 220 to 300 million by 2029?
Exactly. They see full year 2025 revenue landing near 70 million, which is about 20% growth. They're sticking to the long-term plan, but the market wants proof that they can get there profitably.
Let's turn to the technology that's supposed to get them there. The medical imaging story seems to be moving from just an idea to actual product launches.
This is their big, high-margin, long-term bet. They announced 3 endoscope launches based on their VA7000 chipset, and one of those is the market's very first single-use 4K colonoscope.
It's easy to just kind of gloss over a feature like electrosurgical noise cancellation.
Yeah.
But this is a huge deal, right? We're talking about making sure a surgeon's 4K video feed doesn't glitch out mid-procedure.
That's it exactly. This isn't just a nice-to-have, it's a safety and reliability play. The old standards literally allowed for the video to cut out because of electromagnetic interference. Valens's tech fixes that. It provides a continuous, clean video feed.
So they're basically enabling this huge shift toward disposable, single-use medical devices for infection control. And once you're designed into that device,
You're incredibly sticky. It's a very high barrier to entry. Now, the big ramp up in mass production isn't expected until 2027 or 2028, but these launches are the proof that the tech works and OEMs are adopting it.
Okay, so that's the long-term medical story. Let's pivot back to automotive. The financials were terrible, but the tech story underneath seems to be gaining momentum.
Yeah, despite the revenue headwinds, the MIPI A-PHY standard is getting some serious industry validation.
Right. Sony announced an image sensor with A-PHY built right in.
A huge deal. That's the IMX828, the first sensor with an integrated A-PHY interface. And it was developed directly with Valens. When the biggest sensor company in the world builds your standard into their product, that's a massive catalyst.
And it's not just the tech validation from Sony. You also have manufacturing validation from Samsung.
Correct. Samsung endorsed the A-PHY standard for ADS systems, and they're also going to be fabricating Valens's next-gen chip. It just confirms that A-PHY is getting real design wins and has a path to scale, regardless of what the revenue looks like this quarter.
So if you step back and look at the whole picture,
Right.
You've got this high-growth CIB segment, a huge medical option, and real tech validation in automotive. And yet the stock is down 22% in 3 months, while the semi-ETF, SOXX, is up nearly 20%.
Yeah.
Why is there still so much skepticism?
I think it really just comes down to perception versus reality. The market is trading Valens like it's a super high-risk microcap.
Which, I mean, it is. It's sub 200 million market cap.
It is, that's true. But the ongoing gap losses, the CEO change, that Q4 margin compression, all of that is just drowning out the long-term story. Investors are completely focused on the immediate bottom line.
So they saw the great Q3, but they're trading on the Q4 normalization. They want profitability now, not just a story about potential scale in 5 years.
It's the classic battle. Management is pushing a narrative about technology leadership in these high-value niches. But the stock price is just fixated on one question. How fast can the new CEO stop the bleeding?
Okay, this is not financial advice. This is where we take everything we've just discussed and pitch an outrageous but plausible trade idea to spark some discussion. And given the structure here, there seems to be a very specific play that leverages that cash position and the medical store.
Right. The market is just heavily discounting that long-term story. How could someone capitalize on that?
Well, the thesis is that the current stock price, around $1.70, implies almost no value for the actual business once you back out the cash.
Yeah.
That 93.5 million cash pile, that 83 cents a share, acts as a huge structural floor. So the idea is to monetize the market's current fear of execution risk.
Okay, so you're betting the fear is overblown because of that cash cushion.
Exactly. So the aggressive trade would be this. You buy the stock at these depressed prices. Then, at the same time, you go way out in time, say to Q4 2026, and you sell deeply out of the money put options.
Ah, so you're collecting premium today by selling insurance against a total collapse that you think is unlikely because of the cash floor and the medical optionality.
Precisely. It dramatically lowers your cost basis on the stock you bought, and you get paid to wait for that high-margin, sticky, single-use colonoscope business to really start ramping.
You're basically getting paid to wait for the tech story to play out.
So, to wrap this all up, Valens delivered a technically very strong Q3. You had great revenue, amazing cost control, all driven by that CIB segment and the new medical validation.
But all of that good news was just completely erased by the weak automotive segment, the expected margin step down in Q4, and the uncertainty that comes with a new CEO.
The company's whole focus, their special sauce, is this superior noise immunity in really sensitive applications, from endoscopes to car safety systems, and that is clearly differentiating their technology.
It is. So the core question for you, the listener, and for the new CEO is this. Can the CIB and medical businesses accelerate fast enough to get this company to profitability before that cash pile starts to really run low? The market is now focused on one thing and one thing only, seeing a clear, believable timeline for the P&L to finally get into the black. That's what will drive this stock from here.